So the inverse of a Fed put is what we've had this year, and that did result in this icing over. I don't want to say completely frozen, but an icing over of the deals market. For that to thaw in 2024 and for the market to come back, how predicated is it on that gun being fired and getting rate cuts delivered in size?
Well, first of all, I'd like to say good morning and thank you to you and Manas for a great pronunciation of my very complicated last name.
We'll take it.
Which is great.
We're not always good at it, so trust me, it actually is a compliment. We practiced and got yours.
That was great. So what I'd say is that we expect next year to be a big deal year. So both in terms of size of deals, number of deals. The question is, when is it going to start? Why have we frozen up on deal activity today? It's largely because there's been a bid-ask spread disconnect between buyers and sellers. Why is that happening? Buyers still face some, cloudy sort of economic concerns for the end of 24. And sellers, frankly, don't need to sell, and they certainly don't need to sell at these asks. So I think that'll tighten up sometime into Q1 next year, and we'll see more activity.
Well, what is the trigger for that? Is it just enough time has passed? What happens in Q1 that the gap closes?
I think the clock's ticking both on the amount of dry powder that private equity groups and infrastructure funds have raised, as well as the return of capital, which sponsors need to do through exiting their portfolio companies. So as time moves on, and we've seen 18 months of this freeze, we expect that to thaw a bit.
Anthony, good morning to you. It's Madison, New York. You talk about dry powder. We're trying to contextualize the flow that can come in to this market next year. What is the size of the institutional dry powder? I know that on the retail side, there's $5 trillion in money market funds. So that can also seep its way into the system. But from an institutional point of view, what kind of gunpowder is there really to play?
Well, incredibly, we estimate there's $3 trillion worth of dry powder in private hands, and that's the private market, so private equity funds, infrastructure funds, sovereigns, pension funds, and that today is sitting on the sidelines. To offset that, we typically see, and this chart's a great example of it, we typically see something like $1 trillion worth of deal activity. That should be ticking up. It's gone the other way. And so, that gap that you see there in 2022, 2023 will be made up over the next 2 years. It's a fundamental factor, and that needs to happen.
That sounds pretty huge. Is that a record year? Does it have a corollary? Does it look like 2021? What is actually the scale of the explosion from this?
Well, we shall see, but there's certainly a record number of dry powder, record lows in terms of deal activities, and so the difference between the two should mean we would expect at Citi we're expecting 24 certainly to be the beginning, and 25 to be record deal years.
You've mentioned infrastructure funds twice, and obviously I know you have many areas that you look after, but is 2024 going to be a year in which we see this was the year of tech quoted equity behemoth? What is 2024 going to be characterized by? Is it going to be trophy hunting? Is it going to be LBOs? Is it going to be infrastructure in the U.S.? What's going to define the flow, the mandates for you next year? Because you must know what some of them are.
I think, yeah, sure. In the first half of the year, I think we'd expect more defensive sectors, so we'd see more infrastructure fund activity. We'd see food, telecom, and other defensive sectors, healthcare. I think towards the second half of the year, as there's conviction in the market around the U.S. elections rates, I think we'd expect to see much more tech activity.
In activity in the here and now, we've had this recent rate rally, which has resulted in this pretty precipitous drop in funding costs. You look at yield to worst on the U.S. ag, it's at a 4-month low, something like 5.5%. What are you seeing from your clients? Is this kind of like a rare window of opportunity? Schroeder's described it as a frenzy of trying to get borrowing into the public market. Would you say it's a frenzy right now?
I'd say the leveraged finance market is healthy today and will go from strength to strength in 2024. That's largely largely because you open up the year. It's always January, February are always strong leverage finance months. And so we'd expect both the CLO market and the loan market and the high yield market to be much stronger in 24 than today. But again, today, leverage finance is not the issue for financing buyouts. Things will get better next year, certainly. But I think some of the other fundamental factors around equity are the prime driver.
Anthony, January of this year, I sat down with Khaldun Al-Mubarak in Davos, who runs Mubadala, and the idea was that the sovereign wealth funds of the Middle East would be the liquidity providers in absentia of a tightening of financial conditions. We've gone through that. We've had a virtual easing. When you talk to the sovereign wealth funds, can you tell us, are they still massive trophy hunters, or are they liquidity providers? Are they shifting how they want to deploy capital from the Middle East to Singapore? Is there a differentiation?
It's really been an evolving story, Manus. I'd say, let's take the Middle East, for example. The Middle East, the groups in the Middle East with the most capital are continuing to mature in terms of their investment strategies. And that's Abu Dhabi, Saudi, and Qatar in particular. I'd say that's where we're spending the most time today in terms of expectations around capital which will go outbound. And so those groups are gearing up. They see an attractive buying opportunity, and they can deploy in size because they're flush with liquidity. In Singapore and Canada, it's business as usual. They've always been very big backers of the private equity market and will continue to do so.
Are those days of trophy hunting over? That's what I'm trying to understand. What are they looking for? I mean, we had these moments, zeitgeist moments. You're laughing, but I mean, you know, they got their hands on Claridge's, on the Shard, on a whole host of other sort of real trophy moments. I mean, does the UK offer them bigger opportunities than everywhere else? We're talking about mansions that you can't offload in London.
Yeah.
So what are they looking for?
We'll still continue to see that. We'll see an element of that, certainly, and we've seen it certainly with sports clubs. And media franchises. So we'll see that. But I would, what we're seeing is that the Middle East has become incredibly, they're taking a very strategic view on equity deployment internationally. So I don't think it's just about trophy assets. I think you will see that, but I think you'll see some very strategic purchases.
You know, if we look forward from here, if the previous phase of alternative asset managers was this boom, more people cropping up because of low interest rates, is the next phase of this area consolidation? And if so, what exactly does that whittling down look like? How brutal could it get?
It's a great question, Danny. So we'll continue to see consolidation for two reasons. One is as private equity groups, as monoline private equity groups decided to expand and diversify by asset classes, one of the prime reasons was to gain liquidity, increase size and gain liquidity for the public markets, usually founder-driven or employee-driven. I think we'll also see that from a fundraising perspective. There's a synergy. I think a lot of the big LPs are looking for programs to be able to invest in across the alternative asset manager. And so to be able to offer more scale, a scalable opportunity to LPs, I think will become attractive and will be a driver for consolidation.